What is up, ladies and gentlemen, boys and girls, Matt the mortgage guys, Gouges, appraisers, real estate agents, loan officers, home buyers, prospective home buyers? Welcome to the Monday market update. These shows really write themselves these days with all the volatility in the market, the new laws being passed, which we'll get to here in a little bit, the changes in inventory, the changes in expectations about rates. It is always popping off, heating up, and exciting to chat about. I am always excited to chat about with none other than the aforementioned Matt, the mortgage guy, Gouges. Welcome to the show, Matt.
Thanks for having me, buddy. Missed you last week. It's always great to just start my week off chatting about what's going on in the market. And you know, like you'd mentioned briefly, the NAR settlement, the August 17th, being the big day of change.
It's coming up.
State market. You know, I saw something recently where somebody said, what are the two most talked about things in the real estate market? And I answered there, and I think it's true. The NAR settlement, changes to buyer broker compensation, or however you want to, you know, say it, and the future of mortgage interest rates. Like, those two things are what everybody seems to want to talk about. And so, like good, you know, folks we're going to give the people what they want, Sean. We're going to talk a little bit about what real estate agents, this is my favorite part. I'm not going to talk about the nuances of the settlement because that will put people to sleep. I'm going to talk about what I'm seeing in my real life practice of mortgage and dealing with real estate agents on a daily basis. Like, what are they doing? What changes are they implementing? What, you know, do different real estate brokerages do as far as like how they've changed processes, what they're requiring from their agents. And, you know, it'll be a good combo, I believe.
Hey, Matt, what did the pirate real estate agent say about the upcoming settlement?
I don't know. What did the pirate real estate agent say?
NAR.
Almost as good as the one about what was the movie, you know, rated or what.
Oh, yeah. Yeah, exactly. Those jokes, like the show, they really write themselves, the pirate ones. Whenever you find an AR in the wild, in a word. Yeah, we'll hop right in. Did you have a good weekend?
I did have a good weekend. I enjoyed some family time before my youngest was back to school today. So I'm sure, you know, there's people out there that have little ones running around, and that's about that time. People are going back to school. I don't want to get emotional here, Sean, but my youngest son is a 6th grader. It's his final year of elementary school. The elementary school both my boys went to, the elementary school that I went to as a kid. It's kind of like the end of an era, and I wasn't feeling as sappy about it this morning. And then my wife was like, take a picture by this sign. And I took the picture and sent it to her, and she showed me the picture from the first day of kindergarten next to that sign with my same little guy who's not my still little guy anymore. So, Ethan, Dad loves you. Have a great day. First day of school, 6th grade. You're not going to watch this.
Our biggest fan of the Monday Market Update. Ethan.
Who knows? He might go back in the archives later and be like, "What was Dad up to in 2024?"
He could do.
Yeah. What about you? How was your weekend? Is there any bicycling going on or
well, oh my gosh. I honestly,
if there's bikes and food, I know you're in.
Yes. My weekend was very demure. But on Sunday, the women's Tour de France had its final stage, going up the Alpe d'Huez, which is this famed climb up an Alp, a mountain. And it was honestly one of the most like moving and captivating sporting moments I've ever seen. I won't go into it. You guys will get too excited if I start explaining the nuances of women's professional cycling to you. So DM me and I will regale you with stories of the road. But we are on a road to changes. We are on a road to changes. Let's quickly do the numbers here, and then we'll hop into the NAR settlement. I actually end with some stats on inventory here, and but I think everybody should be kept up to date. Last time we met, rates were right about where they are now, about just under 6.5% nationwide, depending on the scenario. All that stuff for conforming, and then VA, which is pictured here on the chart but not mentioned in the top, is all the way down into the high fives, and that has caused many a high five amongst our VA centric staff. Matt, have you seen the evidence of the rate expectations leading to lower mortgage rates for your clients?
Yeah, and I think like the takeaway for anybody listening is mortgage rates are coming down. There's going to be a lot of people that are quote unquote in the money for refinance. The problem is before you're in the money, or maybe a scenario that doesn't make a lot of sense, but it can be posed that way from somebody in a call center, you have to talk to somebody you like and trust. At UMortgage specifically, I'm talking to a lot of other loan officers that like we're genuinely trying to get in front of our database to save some of them some money on a refinance and save others from doing a refinance that doesn't make sense, because it's too easy for somebody who's a numbers geek to kind of throw some numbers around and convince somebody to do a refinance when it might not be the time. So if you are somebody who thinks you might be in a position to refinance, make sure you talk to somebody you like and trust. If you find the wrong person, 100% of the time is the time to refinance. And they're going to find a way to say, oh, it's time. And you're going to look back, or someone's going to look at it who's got an eye for those things, like somebody who's written hundreds of refinances, and say, wow, 5.99% for your conventional deal with that credit score, like that cost you $17,000.
Yeah.
Sure, it saved you $220 a month, but it's going to take you 60 months to break even. If I were you, I would wait until this rate appears at this cost. And there's break-even analysis. There's stuff that you can do to know if it makes sense. Good loan originators live by one motto in my mind. And like, this is something I've always done for the last 10 years. Look at a loan scenario as if it were your own. Help the client make the decision that you would make. Meaning, I'm not going to refinance somebody in a situation where, knowing everything I know about the scenario, I wouldn't do that. Right. And I'll tell people that straight out. Like, I wouldn't do this. 67 months to break even, given the cost versus the incentive. Don't do that. So there's a lot of refinance activity. Week on week last week, we saw, like, I don't know what the exact number was. I think year on year refinance is up 65% or something. It's crazy.
Right. I'm sure most of it's in the last 2 weeks. And yeah, but I will, a lot of those refis are probably not quite good ideas just yet. So yeah, make sure you are talking to somebody you know, like, and trust about that. Last we looked at these predictions, they're actually more like sort of derived chances based on bond traders in the market. We were looking at a much different scene where a majority of people thought there would be either an emergency rate cut by the Fed or 2 cuts at the next meeting. Now, granted, the next meeting isn't for another month, September 18th of 2024. But this chart, if you're not familiar with it, shows the sort of implied odds of the chances of a rate cut based on how bond traders are trading. Because they obviously, when they think that rates are going to go down, they make trades to prepare for that, to try and get in front of it and make sure they're not caught out in the rain. Here you see that 77% chance of one rate cut on September 18th, and then 22.5 people consider it 22.5% chance that there's going to be two rate cuts. So much more calm situation than it was you remember 2 weeks ago? I mean, this number was like in the 60s. I mean, there was even some people thinking there were going to be three rate cuts. So CPI came out last week. There was a reduction in CPI, but not a huge one. I think it came in at 2.9%. And so definitely painting a much better picture for the Fed, but not one that needs dire attention. The jobs numbers that have come out, the weekly unemployment claims, have really shown a cooling economy, but not the one that was painted by the pretty dire jobs numbers from 2 or 3 weeks ago. So
yeah, let me say something real quick on this too, because I was reading it this morning, so I've got something to add here. Even though we don't have a meeting until September 18th, this is the week that central banks from around the globe get together in Jackson Hole, Wyoming. And so we actually have central banks meeting. We'll hear from Jerome Powell on Friday. He'll actually speak. And so generally speaking, in the past, they use this meeting as a way to signal policy changes. And so I think we're going to get some market activity based on what Jerome Powell says. And the interesting thing to think about is 2023, when we had this last symposium in Jackson Hole, core PCE, core CPI, the inflation readings, much, much higher. Unemployment was 3.5%. It's now 4.3%. And so we've gone this whole year in this range of 5.25 to 5.5 from the Fed funds rate. But it looks a lot different, those two metrics, inflation and unemployment. And so it'd be interesting to see what Jerome Powell says specifically about this new data, this new economy we're living in. And my guess is he'll start throwing signals on what the Fed is planning on doing, which most people's guess is 25 or 50 basis point cut in September. Maybe he hints on which one and why.
Yeah, they really do need to get out in front of it. That's great color that you added there as well, Mac. Way to do your homework.
Yeah, that's how I mean, you know what? I'm ready. Monday morning, I got my homework done, and the teacher's like in the front of the class, I raised my hand.
There you go. Something Ethan can aspire to. Looking forward into November, we've got, it looks like the consensus is on a second rate cut, and then looking forward into December, consensus is on a third or fourth. Wait, is that right? Yeah, third or fourth rate cut, which is pretty crazy. So just 3 Fed meetings. They're skipping an October one, or not skipping. They just don't have one. And then going forward into January, you're looking at 4 to 5 rate cuts. So again, I feel like these guys are almost always optimistic, but something to keep an eye on for people who do feel like they're on the edge of a refinance. Like, make sure it makes sense. If somebody you know, like, and trust says it makes sense, then it probably makes sense. If it seems like it costs a lot of money for not a big improvement, then better times should be coming. Now, that's actually in direct contradiction to the advice we give people who are looking to buy a home, which we typically say, like, do it now before rates drop, because it's going to get spicy out there in the market. If you look at existing home sales over the last 12 months, you've got a low in December of 2023. That's not a very fair one. Let's go back to June of last year. You saw about 1.06 million homes sold, and now in this June, and that was pre-giant rate reductions that really happened in July. You're up at 1.32. So about a 24% increase in home sales in just the last year. And that, again, is pre-rate reduction. And that means that more buyers means more price increases. It means higher prices. It means more people to compete with. It means stricter contingencies. It means picky sellers, which, we kind of almost got away from for a little bit, where you could actually, have an appraisal contingency and, put 3% down. And that those times it's going to be harder and harder to find a property that fits that, because you'll see here, you like this? I've constructed a narrative, Matt. Because you'll see here, housing inventory, if you go all the way back to pre-2020, was about 1.2 million homes. We saw obviously the trough there in 2022, all the way down to, I mean, it's just like impossibly low numbers, all the way under, well under 500,000. And things have recovered a little bit here. And then going into July, which we already have numbers for in this chart, we're up close to 900,000. That number, when more people enter the market and homes get snatched up faster, they're on the market for a less amount of time, means that the inventory is going to go back down. Like you can guarantee it with rates going back down, buyers going up, and this probably won't convince as many people to move, right, as it will to enter the market. You're going to see inventory going down. And again, that causes price increases. That causes more competition on every single house. It means that they're on the market for less time. Terms are more competitive, not just price, but like all of the, your earnest money deposit has to be bigger. Your appraisal and financing contingency have to, be shorter or not exist at all. Some, like, I remember the bad old days of no inspections. I mean, I can't recommend against that enough. You should have an inspection. You should have an inspector on dial, like ready to go on speed dial, so that you can get in there and inspect things quickly over the course of a day or something. But it is going to be hot and heavy. So refinancers, make sure it's the right time. Home buyers, it's the right time.
And I think too, just to add real quickly, Sean, because I love when things are simple. My brain understands it really well. Like, it's easy to see how inventory comes down, and like it's at its lowest point in summer of 22. If you go back and look, and I lived through it and I had clients out there submitting offers, summer of 22 was when it was the peak in a lot of markets for price. So if you're a buyer, think low inventory, high demand equals high prices, right? You're competing against a lot of people.
Just like Beanie Babies in the summer of 99.
Right, exactly. And so it's something that no doubt is going to happen. We just don't know to like what extremes, right? If rates come down, how much are they going to come down? How much demand is it going to bring back to the market? Because anybody who tells me that lower rates is going to bring back buyer demand, but it's also going to bring more sellers, like hasn't paid close enough attention. It will bring some sellers, but the amount of buyers it brings versus the amount of sellers it brings is not a 1-to-1 ratio. It's going to bring way more people on the buy side than it does on the sell side. So anyhow, that's all I can say about it. I don't want to come in with a hard sale, but I'm telling people, like, if you don't like competing at 12 or 15 offers and having to waive contingencies and, pay $60,000 above list price, you probably want to buy a house now when it's not as competitive, because it's only going to get more competitive as rates go down.
I agree completely. So let's dive into like a few minutes on the NAR settlement, the National Association of Realtors, who settled a lawsuit that was brought against them by the Department of Justice that said that they had engaged in price fixing or commission fixing, revenue fixing, something along those lines. And it used to be, oh my gosh, I'm going to try to do this as simply as possible, that the seller would pay the commission, pay 6%, 3% to the listing agent, 3% to the buyer's agent. That is no more. Now the seller is still responsible for paying the listing agent however much they want to, but now the buyer is responsible for paying the buyer's agent. Now that can be covered by things like seller concessions, and those seller concessions can still be made public, like the sort of approved level of seller concessions can still be made public in the listing. But it's a much more like, if in a high competition environment, a seller says, you know what, like, come and get it. Like, the buyer should be the one paying their buyer's agent. We're not going to approve any concessions, seller concessions, any money, any rebates to cover the buyer's agent. That might mean you, the buyer, are on the hook for paying whatever you've agreed to pay in advance, because now a buyer's agent can't show you a home unless you have an exclusive agreement with them. You would be on the hook for paying 1, 2, 3% of the purchase price. And those numbers aren't nothing. 3% of a $400,000 house is $12,000 extra dollars in potential cash outlay. There's ways to mitigate this. There are a lot of strategies around it. If you're interested as a client, a real estate agent, or a loan officer, you should definitely come to our NAR settlement webinar by Sky Michaels, one of the sort of leading thought leaders in the real estate agent world, and he is going to like contextualize this for basically all audiences. And highly recommend you sign up and watch this so you understand how your loan officer can help you mitigate this, how your real estate agent can help you mitigate these new strictures, and how important that is. I think Matt will agree with me that the number one most important thing you can do is work with a highly vetted real estate agent that has got a great reputation in your area, and pair that with working with a highly vetted, great loan officer from UMortgage that is well regarded in your area. So definitely a crazy opportunity to learn and position yourself with as much information as possible to have as many negative effects mitigated as possible.
Yeah, I mean, and I had a funny conversation yesterday, just hanging out with family, and somebody asked me, like, just break it down for me in layman's terms, Matt. Like, what's the change? After 5 minutes of back and forth, they looked at me and they're like, so not really much is changing. Like, it's still all negotiable. Like, for most people, it's not even going to be a thing. And that was kind of where we ended. Of course, Sky Michaels, who's got experience as a high producing real estate broker, who's actually coaching real estate agents now, is going to break down like how to best explain it from a real estate agent perspective. But for buyers in this new environment, what they're going to notice as a change is they're going to sign an agreement. A lot of real estate brokerages are making it mandatory before they even go look at a house. I heard
it's not even brokerages. It's now a NAR rule. It's like you have to do it.
Right. So you sign something saying, I'm working with Sean as my real estate agent. I'm going to pay him 2.5%. Now, on the front lines, I've talked to real estate agents who are high-level real estate agents, and they tell me the conversation they have with their client is, Matt, don't worry. We're going to negotiate that like we always have. It's not going to come out of your pocket.
It's a little oversimplification though, because there's no guarantee. You can't control what the seller chooses in that case, which, you know, in the past, you knew exactly what the seller was going to pay the buyer's agent. That was all handled at a time.
But in this realtor's defense, price, concessions, all that stuff is always negotiated between agents. So now it's just adding that extra layer of, oh yeah, the commissions is also going to be negotiated. Because as a seller, if you said 0 to buy side, that agent comes in and goes, no, we're going to negotiate that. Like, I'm getting 2.5%, and I want you to pay it, not my buyer. And so
I think you're mostly right. I think we're going to see a proliferation of flat fee buyer's agents who say, I work for $5,000. Like, that's it. So if it does have to come out of your pocket, buyer, that's how much it's going to be. And then it's going to put them in a better negotiating position with sellers as well. So like, I do think it's going to have like a significant impact on people's experience in buying, more so. There's just going to be a little more friction, and there is in high competition markets. I mean, that seller might just say like, the seller might just say like, we're not going to pay your commission. You know, you can always raise the price and cover it with like, fake concessions, but then you might have appraisal issues in an already competitive market where prices are higher than market. So I think it's gonna anyway.
It's good. Yeah, it's going to be different. And I agree with you too. Something that you mentioned, I just want to point out real quick, which you're spot on. In different markets, it's going to matter to different degrees. Like in a market where the sellers have all the leverage, it's going to matter more than a market where there's plenty of inventory, there's not enough demand, and sellers like, oh yeah, you need 2.5%. You also need 5,000 for a buy down. Like, cool. As long as you pay me my price, we're good. And so for sure, that's going to happen. What I want buyers and consumers to know is now more than ever, like, you don't want to work with Sally or Joseph that does this part-time. You don't want to work with an agent who's not plugged in, doesn't know how to negotiate, isn't great with relationships in this community with other agents. Those people are going to be impacted and hurt the most, in my humble opinion.
I agree. We got a couple questions in the comments here.
Oh, let's do it.
One is for Jay Homeboy. Welcome back, Jay Homeboy, a loyal listener, watcher. He says he's 2 years into a 30-year fix, which you're ahead of by 5 years, crushing it. So you're making extra payments. Is it best to refinance to a 30-year, 28-year, or 25-year? I'm curious to hear your thoughts, Matt. You got 30 seconds on the clock.
Okay. If you're going to refinance, one, there's got to be a rate benefit to it. You don't just refinance to a 20 for the sake of it. In my opinion, with it being such a small margin between a 30, a 25, a 20, and a 15, you just turn it into whatever you want. You've already got 5 years ahead by just making extra payments. You can do that on any loan you've got. And so I think the analysis that I do with clients, I did a lot of this. How long do I have? A minute?
No, you got 12 seconds.
Make sure that you have a lot of things considered, right? I can put you in a 30-year with a rate that's within a quarter of a 15, make extra payments, have flexibility because things are going to change. The end. All right. I know I'm long-winded, bro.
Dude, I think you crushed it. All right, I'm going to give myself 30 seconds. Yeah, I agree with Matt. And I think one of the caveats is you're not going to get a better rate on a 30, 28, or 25. Like the rate changes happen at essentially, it used to be you might get a small one at 20. I don't even think that adjustment is there anymore. It's just at 15 and it's not worth it. If you pay an extra $500 a month on a 30-year versus that being what the 15-year payment would have been or whatever, then your effective APR is usually like 0.1%. Oh, I'm out of time. Is usually 0.1% high or something like that. So you're paying a very, very small premium to have, like Matt said, a ton of flexibility. Let's move on to the next question.
Okay. You know what I might do? And I'm going to start off by saying I don't have the 9 I usually have on Mondays. My buddy Mike Zuber's out of town.
Okay.
So if we spill over, I got time. I just love this question, Jay Homeboy. And so I gotta add one more piece to it. The reason you're like, why would you just recommend going to a 30? Why not force myself to pay it on a 20-year or 15-year schedule? Because things change. And I'll give you a specific example. Somebody says, I want to pay this off quick. Great. That's nice. You get 3 years into a 15-year loan and you're like, you know what? Now we're moving. Now this property is becoming an investment property. We're going to keep it in the same rate mortgage. But since I've structured it as a 15-year, now it loses $400 a month. Give yourself the flexibility by paying it aggressively and essentially turning it into an 11, 12-year loan by your payments, knowing that if you move out and now you want that to pay on a 30-year AM and have it cash flow and have the tenants pay, you have the ability to do that. With the 10, 15-year loans, you're locked in. No flexibility. With the 30, no prepayment penalty. Pay as much as you want. Make it as short as term as you want and remain flexible, because you might even get to the point where you're trying to buy another 4, 5, 6 properties and debt to income ratio becomes something to think about, right? So
that's a good point. That's a really good point. Yeah.
A lot of conversations around that with clients.
I agree. And just so you guys know, full disclosure, loan officers don't get paid any more or less money depending on what product. So like 15-year, 30, like if you're paying it for longer, it's not like it's in our best interest to have you paying it for longer. It literally makes no difference to us. We just want you to make the right decision. All right. We've got a great question here from Akma. Can you guys provide the very basic explanation of here? I will reshare that chart real quick too. We're going to go 3 minutes over.
Yeah, this is a good question, and I'm glad you asked it. Thanks for asking it, because I'm sure there's other people that are like, what are they talking about, the Fed funds rate and the range?
Yeah, I agree. So it's on us to be a little bit more clear about this. We're definitely very inside baseball when it comes to this. So, I mean, one of the most confusing aspects for sure is that these are given in ranges, and I'm going to be totally honest. I don't completely understand how those ranges are. Well, I understand it's always 25 basis points. So a basis point is 0.01%. So 25 basis points is 0.25%. 100 basis points is 1% change in the rate. I guess there's some fluctuation between those rates depending on the market that they set. And so that's why they're given as a range. Right now, the range is 525 to 550. So 5.25% to 5.5% is the cost to borrow money from the Fed. And these loans that people get from, or institutions get from the Fed, they're usually considered overnight loans. Sometimes they last longer than overnight, but it's kind of basically a clearinghouse to settle people's books. It's very wild. And the reduction is there's, like you said, there is a 78% chance of there being a reduction to the 500 to 525. So the 5% to 5.25% rate. Now that doesn't mean your mortgage rate is going to be to 5.25%, because mortgages are 30 years. They're not overnight. So there's going to be obviously an additional premium you have to pay for having a mortgage, but things do move in the same direction as the Fed funds rate. You can't really draw a direct line between, well, if the Fed funds rate is this, then what will mortgage rates be? There's too much anticipation of the future kind of baked into mortgage rates of the day. But yeah, so you're absolutely right. It has a high probability that there is going to be a reduction on September 18th, and a small probability that there will be a double reduction, but a 100% chance, according to traders who are always wrong, just like me and Matt, there's a 100% chance based on the data available that there will be a reduction on the September 18th meeting. Now, there have been plenty of 100% chances in the future that have not, in fact, been 100% chances, but the implied odds show a 100% chance. So, great question. We will try and make that as simple as possible when we explain it going forward.
Yeah, and I think what I try to, tell people is, like, this isn't the tracking of mortgage rates, so it's not the same thing, but mortgage interest rates will follow, right? As the Fed cuts the Fed funds rate, mortgage rates come down, car loans come down, what they're paying you in your savings account comes down, because, if the banks are borrowing money cheaper from each other, which is what the function of it is, then they can afford to let you borrow the money at a cheaper rate too. So I don't know why I'm not allowed to post here. I'm having problems with posting, but Kyle, who had a question about refi, you're in California, Kyle, shoot me an email, matt@mtmg.com. I'm happy to chat with you about, like we talked about, when it makes sense to refinance this investment property that's at 7%. It won't be now, because even though I got AFR offering some smoking rates on non-owner occ loans, it's probably not a big enough loan where going to 6.5 is going to make sense. But send me whatever info you want, Kyle, to matt@mtmg.com. We're going to take a look, and then you're going to be in my handy dandy system, and it's going to be the rate we're looking for at the cost we're looking for, all in a column in kind of like this refinance waiting room. And when the target appears, we're going to bam, we're going to get it.
Love it. Love it. Love that. Opportunity to help a fellow Californian. Is Oakley, California near you?
Oakley, California, who knows?
It's a big state.
It's a big state. There's 40 million people. Oakley, I think, is in Northern California. Embarrassed if I'm wrong, but I feel like it's close to me.
It's near it's just outside of San Francisco. It's halfway between San Francisco and Sacramento.
Oh, see, I knew it was up here somewhere.
There you go.
Yeah.
All right, buddy.
This was better half of California, the northern hemisphere.
Oh, I don't know. That's kind of a crazy thing to say. Have you ever been to San Diego? Have you ever been to Tijuana, the best part of California?
San Diego's nice, but still, there's like this big SoCal NorCal rivalry. I love all of California.
Eat it. Go get it. Go get a taco in both places and then come back. Come on.
Well, there's going to be some good food down south for sure.
That's all I exist for. All right. I hope you have a fantastic rest of your week there, Matt the Mortgage Guy. This was a fun one. I can't wait to do it again next week.
Yeah, let's do this again next Monday. I thoroughly enjoy this, Mr. Sean Grapevine. Thanks for all your wisdom. Thanks for all the questions in the comments. If you ever join us, feel free to fire off any comments. Ashton Hamby, I saw her say something in there. Thanks for joining. My buddy Mark out in Hawaii, financial firefighter, joined us. I really like it when me and Sean can bounce ideas off each other, and then we can, wrap with a couple people asking questions in the comments. This is fun.
Yeah, loved it. All right, buddy. I'll see you next week. Have a great weekend.
Later, brother.